Hi, and thanks for watching episode 5 of our Trader series. My name is Vincent and I work at Maven. Today I would like to discuss indexes or indices and ETFs. It's part of the equity series, so we're still talking about stocks like from the last episode. Indexes are created by index providers, and you see a couple of examples on the slide. Back in the days, people figured out that investors are not too keen on investing in one or two single stocks. They want to have a more diversified portfolio. So, historically speaking, there were some indices constructed geographically. So you know a couple of them like the FTSE or the DAX in Germany or the S&P 500. This way, it allowed investors to create in a basket of stocks that kind of diversified the risks a little bit. Later on, sector indices became popular. Something like, some investors might think, I would like to invest in tech in general. Well, if you buy, let's say, a stock in Facebook, but Facebook goes bankrupt, you lose all your money. But in fact, if you invest in a couple of tech stocks, then, one might go bankrupt, but still you have possessed the other ones. So they thought, all these index providers, let's also not only create nationally constructed indices, let's also do a sector index. For example, a tech index, which exists, we call it the Nasdaq in the US. Popular other sectors, which all have indices in itself, are oil, banks, and pharmaceuticals. All right. One thing that you have to be wary about, you cannot directly invest in an index. An index is just a number. The S&P trades 4,000 points. That's it. What you can do, you can buy each individual stock in the S&P, but that will be a costly exercise. So how an investor typically would trade this, we will speak about in episode 7, for example, but also today. Anyway, if you are invested in an index, it's a much safer way of doing so, as I told before, and also indexes are less volatile. A single stock can move up and down a considerable amount. However, an index is a basket of stocks, and some stocks might go up and some stocks might go down, and that kind of balances, it could balance out on a particular day, but only when correlation picks up, then a whole index can completely collapse, let's say if there's a lot of market turmoil. But typically indices are less volatile than single stocks. How is an index constructed? It depends a bit on the index provider. But typically an index is market cap weighted. Let's say there are 50 stocks in the basket. One company is maybe a big company. A big company in a sense that how to measure it, you take the stock price and you multiply it by the amount of shares outstanding. And that tells you something about the size of the company. And in that particular way, these stocks are weighted in the index. So each stock has a different weight in a particular index. Some indices are price weighted. Just the highest stock price is what matters in terms of the weight, and some indices are completely even unweighted. Every stock has an equal weight in the index. But I think market cap and price weighted are some sort of common. One extra thing you need to understand is that some of the stocks in the index will pay out a dividend. When a dividend is paid, part of the profit of the company is paid out to the investor, the stock price will drop a little bit. So does it mean that then also the index where that stock is in will also drop? That depends a little bit. Some indices are total return. That means that any dividend that is paid will get reinvested back into the number itself. And some are just a price index. For example, the Euro Stoxx is one of them. So if there's a stock that is in the Euro Stoxx paying a dividend, then the level of the Euro Stoxx will drop just by a little bit. That's how it is. That's the difference. And this is the official mathematical simplified formula of an index. You see here, this is the sum of all the stocks in the basket. This is the stock price multiplied by the number of outstanding shares. And there's a D in there. They divide it by a divisor, which is a number provided by the index provider. And the D also gives kind of the opportunity to the index provider to kind of make a difference here. So if a dividend gets paid, they can actually adjust the divisor a little bit such that the level of, in our example, the DAX stays the same, whereas in the Euro Stoxx it will drop just by a little bit. All right. Now I owe you an explanation. How can you invest in an index in a way? Well, one way of doing it is trading ETFs, and some of you already know what an ETF is. When trying to replicate exposure to any index, you can decide to invest in an index ETF. We would call it an index tracker. And what is good about an ETF, they're typically quite liquid, transaction costs are very low, and also they behave like actual stocks. They don't have a weird maturity date or something, they pay out a dividend. It's like very straightforward. However, what's happening behind the scenes can be a bit complex, but it's worth understanding. So imagine I have a very simplified sector car index, and only Volkswagen, BMW, and Daimler are in that particular index and weighted in a particular ratio. So if you want to replicate exposure to this particular index, you should be doing something like this. You should buy 1 share of Volkswagen, 2 shares of BMW, and 2 shares of Daimler. And only then you're perfectly replicated into that index. But if you look at it and you want to do this thing, you have to pay 360 euros, which can become a bit expensive. How ETFs work, an ETF issuer, like BlackRock or Vanguard or something, we call it a sponsor, uses market makers, authorized participants, we would call it, to create ETF units. This would be an ETF unit, and this consists out of 50,000 ETF shares. The dynamics I will tell you on the following slide, but how it roughly works is what they do, they create these kind of big building blocks, let's say 5,000 shares of Volkswagen, 10,000 shares of BMW, and 10,000 shares of Daimler, but you can slice and dice these blocks into as small pieces as you want. So for example, one ETF share, for example, can exist out of only 0.1 stock of Volkswagen and 0.2 stocks of BMW and 0.2 points of times Daimler. Which is interesting because now if you buy this ETF share as an investor, you only buy 10% of the total amount, but you still have the same exposure to this particular index. Right? So what they do, these dynamics allow to basically buy an enormous amount of Volkswagen, BMW and Daimler in the right ratio, that's important, and then slice and dice it back into smaller pieces. To so small extent that you can, as a retail investor like you and I, only need to pay 36 euros to have the same exposure, rather than just actually buying the whole chunks of shares. Okay, and how the dynamics really works is on this last sheet. So this would be a market maker. A market maker would literally buy all the stocks in that right ratio in the market, in the stock market, and kind of with the constituents go to the sponsor and say, can you kind of wrap these stocks into this ETF building block? That's what they will do. And now the market maker can actually go to the public, to you and I, to our brokers, and sell these smaller ETF shares. We would call this process creation. We create ETFs. And the opposite of creation is redemption. So at some point we can do the opposite again to transfer back the ETFs, unwrap it, and get it back into the single stocks again. That's the process. Okay, this process is a bit complex, but hopefully in summary you understood the most important things. Indexes are created to have a more diversified portfolio. You cannot directly trade into an index. You can do it through an ETF. You can do it through a future as well, which we will see later. But ETFs have very low transaction fees. They track a certain indicator like an index, and they're very liquid. Hopefully you got a bit of insight into indexes and ETFs, and stay tuned for more episodes.